This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Lack back on the show. Now joining us again in the Postgame segment is Nick Galarnik. Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Lack's picture saying, looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory data.
EIA printed a build of 3.6 million barrels nationally and then 1.9 million barrels desperately needed in Cushing, Oklahoma. Finished products were the drawdowns on the board, with gasoline drawing down 1.5 million barrels and distillates drawing down 1.4 million barrels. U.S. production was unchanged at 13.2 million barrels. The supply deficit predicted by almost everyone just plain isn't happening. That means black market oil is bypassing sanctions and entering the market, and that in turn means that analysts who are working from official data will continue to get their predictions wrong. So I think we're moving into a guessing game market where analyst predictions based on official data are not going to be reliable. Crashing time spreads on WTI bode of more weakness to come. The third month shows only 3 cents of backwardation, and the out months are falling fast as both national and Cushing inventories are finally starting to build again. If the whole curve moves into structural contango, that suggests a much bigger bearish move could be afoot. And by the way, folks, it always starts at the beginning of the curve, which is what's falling into contango right now. So we need to watch those out months, 6 months to 12 months out on the curve, and see if those time spreads continue to move lower. And if they start to fall into contango, we've really got a serious bearish indication. But for now, it's only an early sign. As of this recording, just after the European Open early on Thursday morning, we're just barely holding on to the 200-day moving average on the contract chart on WTI. We're well below the 200-day moving average on the continuation chart, and we're also below all three of the short-term moving averages, the 5, 8, and 13-day moving average. This is after we had a failed rally a couple of days ago, right at the 13-day moving average, which is a textbook failure point. For now, at least early on Thursday morning, we're still above that 200-day contract moving average. If we can stay there, maybe there's a chance of recovery. But if we get a daily close below the 200, which is 76.18 on the January WTI contract, if that happens, we're probably headed back lower. The next major supports below the market are 73.28 and 70.03, which is the 200-week moving average. Israel's military had a flag-raising ceremony in Gaza last Friday, and that caused Iran to reiterate that any occupation or annexation of Gaza is certain to result in a broader regional war. But so far, markets are ignoring those statements.
While it was a very steep pullback in crude oil over the last couple of weeks, I was looking to see how the price action would behave during a bounce. And so far, the price action is disappointingly weak. And the longer we spend below $80 on WTI, the more likely it is that the market is still got further weakness as the prevailing trend will remain dominant. In my mind, the only way that we've established a trading low is if we get back above 80 on the short term and the bulls really start putting together some back-to-back days on the upside. Is it in the cards for us to go and retest the third quarter lows? It's not a scenario that I put a lot of weight to originally, but right now with the way the price action is behaving, it's certainly something that can't be taken off the table. Moving on to equities, though, Eric, what's your thoughts here on the markets?
Well, just looking at the chart alone, it's extremely bullish, and the next major upside target for the S&P is 4612. But let's look a little more closely at what's driving all this exuberance. The big event this week was Tuesday morning's CPI print. The market is acting as though an earth-shattering event just occurred, absolutely positively guaranteeing that rate hikes are done and forgotten, and that rate cuts are surely just around the corner. Wait a minute. All of this hopium was fueled by a lousy 0.1% miss on consensus expectations for the CPI print? I think the market is really reading a lot more into this than actually happened. One print doesn't make a new trend, and nothing ever goes in a straight line. It's entirely plausible that the peak rates moment that everyone is obsessed with is now behind us. Just like it was plausible that the so-called dovish pivot from the Fed might have happened each one of the 17 or so times that market pundits declared it to be imminent in the last 3 years. But it's also equally plausible that this is a normal pullback and that inflation will return. More to the point, it's also plausible that the reason inflation is falling is that the hard landing and recession that Locke predicted in the feature interview is about to hit the economy. My point is, it's too early to know for sure where we stand, and I think the hopium was exaggerated on Tuesday. As of this recording, stocks are still holding their gains, but both gold and oil have given back much of their Tuesday gains, so to my thinking, the jury is still out. Declining inflation isn't bullish if it's actually signaling the beginning of a deep recession, and nobody seems to be considering that angle.
All right, I want to get Nick in this conversation. Nick, what levels are you watching on the S&P?
Yeah, Patrick. So spot price right now on SPX is 4,500. We have a call wall right at this current level at 4,500 and a put wall below at 4,200. The implied move for the December 15th monthly OPEX is plus minus 120 points. Thus, the upper potential move is 46.20, and the lower potential move is 43.80. I'm inclined to think that we see some consolidation / downward action perhaps. Now, we have 4 gap fills below right now on SPX because we declined in about 2 weeks' time about 6.55%, hit a low at 41.05, and since then, in just 12 trading days, we're up 10.2%, which is a substantial rally. I think it was a lot more than people thought would happen. And right now we have 4 gaps below. The gap at 44.11 is what I'm targeting for a possible consolidation level. So about 2% decline from the current levels. And I do think we get a late year rally perhaps to that 46.50 mark, given that we've already breached the 4,500 area. I don't really see a catalyst for downward action. Although there is FOMC just before the December OPEX on December 12th and 13th. If Powell does sound off on keeping rates higher for longer, that may trigger a downward move in broad markets.
To me, it's incredible that there was such a huge short squeeze on the S&P 500. It just shows how offside participants were, where sentiment could cause such a huge reversal in trend. But now that the NASDAQ is pretty much testing its major highs and the S&P 500 is stone throw away from there, there's no asymmetry in pressing the long trade. At this moment, we're going to see some sort of a consolidation, and the way the bulls can buy the dip and defend pullbacks is going to be the real key information as to whether this trend can continue into the holiday season. So let's see whether or not all pullbacks can be held above moving averages and fib zones, and we'll see how it progresses from there. What are you watching on the NASDAQ in terms of the levels, Nick?
Yeah, Patrick. So on Qs right now, the spot price is 385. We have a call wall just above at 390 and a put wall below at 345. The implied move is plus minus 14 points for the December 15th monthly OPEX. Therefore, the upper expected move is to 399, just below those all-time highs at 408, which also act as key resistance. And we have a lower expected move of 371, which is just above the lower support at 370. But keep in mind that next Tuesday we have NVIDIA's earning report, which should sway the tech sector a fair bit. But right now, given that we're so close to all-time highs, again, I'm very, very skeptical that we're going to see a push up there. for the simple reason that a lot of these names are very, very overvalued. And in the last couple of weeks, with such an extravagant run in the markets, I think it's possible we pause or decline. And I'm much, much more inclined to favor the small caps in the form of IWM, which have done pretty well the last couple of weeks. Now, moving on to the US dollar index, what are your thoughts here, Eric?
Well, we've finally broken out of the 105 to 107 consolidation range decisively, setting up a new downsloping price channel on the Dixie chart. Now the question becomes, what's the next downside target? And I don't have an opinion on that, at least not yet.
Yeah, incredible drop on the dollar on the CPI, but we haven't yet even 50% retraced the summer rally and the rally we had throughout the third quarter. The dollar at this stage continues to be vulnerable to consolidate for the rest of the year, but generally I still believe the dollar will prevail with a bull run. So I think that the consolidations toward 103 can still happen and even take more than a month to consolidate in those zones. But overall, we're already 3 points off of the highs, and certainly I think much of the damage is already rear view mirror. I think a further 1 point downside risk over the course of a month is a more realistic expectation in terms of what to expect here next.
Now, moving on to gold futures, what are you guys thinking here?
At first glance, the correction appears to be over, and gold looks to be headed back to new all-time highs. But hold on, let's not get too excited, at least not quite yet. Almost all of the reason the chart looks so much better this week than it did last week is the big move up in reaction to Tuesday's CPI print. And as I said in my equities commentary, I think the exuberance was a little bit overblown. The move higher took us to a textbook test of the 13-day moving average, the highest of the 3 short-term moving averages. And just like oil, that's where the rally failed. Unlike oil, gold is still above its 5 and 200-day moving averages at 1957 and 1949 respectively. And so long as it stays above those levels, we can say that a new uptrend may be forming. But a break and daily close below 1957, and particularly below 1949, could signal that a test of the 50% fib level at 1922 is still on deck before this correction in gold is over. On the other hand, what would persuade me that the move toward testing all-time highs really is on would be a close over 1982, and for the market to stay above that level for a few days. That would put all the moving average resistances below the price action and clear the way for a move first to recent highs at 2020 and then on to retest the all-time high at 2085.
Well, typical reaction in gold, in my mind, as gold is strengthening in a period where the dollar is weakening and we're risk on in general, and as we approach potentially the Fed pivoting and eventually an easing cycle, which typically is a tailwind for gold, we see gold and silver both reacting off their lows. I really want to see gold clear 2,000 on the upside where we were just trading a few weeks ago in order to really confirm that some new bull trend is resumed, and so it's certainly going to be important to see whether that follow-through emerges.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.